We spend a lot of time in cryptocurrency talking about all the variables that we believe have the potential to create major impacts on the market. Lately, much of that conversation has centered around ETF approvals and market cycles. Those factors are undeniably important. They still have a major influence on the space. However, there's a deeper shift happening behind the scenes that could be equally significant. Quantitative tightening, you may have heard this term before. You're probably familiar with quantitative easing, but quantitative tightening, which could end on December 1st, is the opposite process. QT has quietly been draining liquidity from global markets, including cryptocurrency and traditional assets alike. The ripple effects are broad, influencing Wall Street and extending into areas such as DeFi, altcoins, and essentially every liquidity-driven crypto asset. In fact, the market already seems to be signaling changes directly related to this shift. So in this video, I want to decode what central bank policy means for digital assets and highlight 3 altcoin projects that I believe are best positioned to benefit. Welcome to the channel. My name is Kalen, and this is Kalen Moss Channel. If you choose to invest, I wish you the best of luck. Just remember, I'm not a financial or investment advisor, and this video is not official financial or investment advice. The Federal Reserve and quantitative tightening recently, the Federal Reserve cut interest rates by 25 basis points, a move that came as no surprise since it was largely priced in already. But as mentioned earlier, the bigger story here is the ending of quantitative tightening set for December 1st. Quantitative tightening is a monetary policy tool used by central banks, not just the Federal Reserve, but others around the world, to reduce liquidity in the financial system. It is the opposite of quantitative easing. Here's the difference. Quantitative easing injects money into the system by purchasing government bonds. Quantitative tightening withdraws money by selling those bonds or allowing them to mature without reinvestment. The result? Cash is removed from the economy, shrinking the central bank's balance sheet. QT is primarily used to control inflation and cool overheated markets by making borrowing more expensive, reducing liquidity, and tightening financial conditions, all of which lead investors to take fewer risks. The two markets most sensitive to QT are equities and cryptocurrency, both of which are liquidity dependent. As QT progresses, it influences yields, interest rates, and credit availability. When central banks sell bonds, yields rise, pulling capital away from risk assets. This strengthens local currencies and suppresses speculative momentum. Prolonged QT, however, can strain global liquidity and trigger volatility, or even credit stress, across markets. When QT ends, liquidity tends to return and risk assets rebound. Investors closely monitor these shifts because liquidity drives both sentiment and price action. In short, quantitative tightening removes fuel from financial markets, and understanding its timing and scale helps predict capital flow into or out of crypto and other high-risk sectors. What happens when QT ends? When QT ends, central banks stop withdrawing liquidity. Financial conditions ease, and this often leads to renewed inflows into risk assets like cryptocurrencies and altcoins. Capital typically rotates from safer assets into higher volatility, higher reward ones, giving altcoins a potentially clearer runway to perform as expected. This timing could also align with the long-anticipated alt season, which has been delayed so far. However, it's important to stress, the end of QT doesn't automatically mean a massive price rally or liquidity injection. Any upside will depend on actual liquidity expansion and investor confidence. This is one variable among many in a complex macro model. It's also possible that the market has already priced in the upcoming policy change, which could reduce its immediate impact when QT officially ends on December 1st. Even in a favorable macro environment, altcoins still face unique risks, including technical and regulatory developments, tokenomics, network health, relative competition. Macro shifts help, but fundamentals still matter. Strong projects with solid on-chain performance will benefit most. So, while this policy change could create new opportunities, it's not a golden ticket, and it certainly doesn't guarantee an altcoin rally by itself. Still, It's a major factor worth understanding. Altcoins likely to benefit from the end of QT with all that context in mind. Let's look at the 3 altcoins that I believe stand to benefit most from the end of quantitative tightening. Solana is currently in the spotlight thanks to the launch of 2 new spot ETFs, one from Bitwise and another from Grayscale. The Bitwise ETF launched with $222 million in assets and generated $56 million in volume on its first trading day, impressive numbers by any standard. Additionally, Western Union recently announced it will use Solana, not XRP, to move an estimated $100 billion per year. While Western Union may feel outdated to many in crypto, its global reach makes this institutional partnership significant. Despite all the positive news, Solana's price hasn't reacted strongly yet. As of now, SOL trades around $187.87, with a $13 billion market cap. The second altcoin position to benefit is Ethereum ETH. Bitmain's Ethereum treasury strategy, led by Tom Lee, continues to grow, similar to what Michael Saylor has done with Bitcoin. Recently, Bitmain purchased an additional $135 million worth of ETH, bringing their total holdings to approximately $13 billion. Their public goal is to control 5% of all available ETH. When capital rotates into altcoins, Ethereum is always first in line, followed by large cap, mid cap, and then small cap coins. Currently, ETH trades below $4,000, up slightly on the day. If you're satisfied with a potential 2x or 3x return, accumulating ETH could be a reasonable play as we approach the end of 2025 and enter 2026. So, what do you think about the end of quantitative tightening and its potential impact on altcoins? Do you believe it will help ignite the next phase of the crypto bull run in Q4 2025 or Q1 2026? Or do you think it's already priced in? There's a lot to unpack, from macro variables to on-chain fundamentals, and plenty of nuance in how this plays out. Let me know your thoughts in the comments and see you soon.